Hello, good morning. It's Friday, 31st of August. We're coming to the end of quite a volatile month. Today I'm joined here with Steen and Peter. We're going to take you through some of the current themes. Overnight, some of the major news was Trump yesterday gave a press conference, and in it he once again stated that he was prepared to slap 200 billion extra dollars worth of tariffs on China next week. He's also threatening to pull out of the World Trade Organization, and he's told the Europeans that their offer for compromise is not good enough. So that's going to create some additional focus. We have emerging market worries, which remains with us, primarily driven by Argentina and Turkey. We're going to take a look at that. Then we're calling it Quit Italy, because obviously Italy is increasingly making a lot of noise, and it's unnerving the market. We're going to take a look at that. Tencent is down overnight. Peter's going to help us sort that out, and then just take a look at commodities for the month. But I think we'll just go to the first slide here, because really it has been all about emerging markets this month, and we see some really big drop-offs. Turkish lira is down nearly 25%. I should have put in the Argentinian currency as well, but it's almost out of the scale, so it's down even more than the Turkish lira. Steen, will you give us your thoughts on emerging markets? What has really been going on here?
No, it's still the same story, that the U.S. market is an island of peace, because they have dividend yield, their dividends being paid back, repatriation, and they have buyback programs. And they're doing that to the tune of 1 trillion. But what's interesting, of course, is that the policy from the Federal Reserve of quantitative tightening, it means that the rest of the world, which is dependent on that very dollar liquidity, is short of the liquidity, which means that the emerging market gets hit. And as China is in between sort of a slowdown from the deleveraging and the start of a re-acceleration, or at least an attempt to re-accelerate, these emerging market currencies that has the highest amount of deficits, the highest propensity to be impacted, they are the ones you saw in the chart that you just showed.
Yeah, I suppose, Peter, stock markets, obviously, they reacted to it as well.
Yeah, we had emerging market equities down 1.7% in yesterday's session. So we have almost now erased all the gains we got earlier in the week, and it just confirms that we have a very weak outlook for emerging market equities. And I think that will continue to be the theme until we get the firm evidence that the Chinese stimulus, both from the fiscal and monetary side, is really working through the economy. Until that point, I think we will be in a technically and fundamentally weak position in the emerging market, not only the equities but also in bonds.
Yeah, and just an example, yesterday the Argentinian central bank hiked rates by 15% to 60%, and nevertheless the currency dropped by 12% on the day. So it's clearly not, these measures are not working at this stage.
But the interesting thing, we talked about it yesterday, right, in the office. There's always this notion, if you just hike the interest rate, you can fend off the speculators. But you always, when you hike interest rate that much, it's from a very weak position. Yeah. And the market never really buys it. We have seen it before in Sweden, more than 2 decades ago. We've seen it so many times. Yeah. It never really works. What the Turkish government needs to do is they need to separate the son-in-law from the finance ministry post, and then they also need to create more independence around the central bank and introduce more reforms that are market-friendly.
Yeah, absolutely. And I think just to turn to the table, just to the green one on the right is Swiss franc, and I think that could lead us into the next one, which is obviously Italy. But just before we do that, I just want to, you probably noticed that John Hardy has not been around this week, but he is still here, and he's made a webinar earlier this week, just taking us through all the current ins and outs of the currency market. So I suggest you take a look at home.saxo/insights just to give just to see his latest webinar. But Steen, Swiss franc is one of the best performing currencies this month, and I suppose some of that is due to the worries about Italy. Euro is not as safe as it should be.
No, absolutely. Swiss franc has become a proxy for what goes on in Italy, and to some extent what goes on in Turkey. And Italy is, absolutely pursuing a plan which is to create a confrontation with the EU. This morning we saw that the EU took debate. They are now pushing back, saying that going beyond the 3% threshold embedded in the budget talks in the Europe is going to be very negative. And the headline this morning is through and through. And we have a small chart to show how the market is actually getting concerned. As the chart here shows, this is the 10-year Italian bonds yield from on one side, the blue line, and then the green one is the CDS, so the insurance premium, or 5-year insurance premium in Italy. And as you can see, we are hitting recent highs in terms of that we could break through later today if this increase in rhetoric continues. And I think what we're seeing around the world is not only that politically we have this populist movement moving into gear and becoming powerful, but it's also the case that the policy they pursue in case of Trump, in terms of Erdogan in Turkey, and certainly in the Italian government, is one of confrontation, which means for us as investors, we're going to be facing more volatility, more political headlines driving the marketplace, which I think overall is very negative. And it comes at a time where the remedy for everything is still to spend money you don't have in terms of fiscal expansion, as Peter alluded to, and certainly creating debt even among the corporates, including the US.
Talk about the corporates and companies, Peter. The Italian stock market is clearly suffering as well.
Yeah, it is suffering. If we have a chart with us today, and it clearly shows a no upward trend for 5 years, and this is the FTSE MIB index. And on a valuation perspective, we're trading at a 50% discount to MSCI World. It's one of the most heavily discounted equity markets. Sort of really reminds me a little bit about the Russian equity market. That was a big theme, I think 3-4 years ago, and Russia equities was so dirt cheap, but why would you not pick it up? Because of the political risk. And I think that's the reason why you should not buy this value case. I think it's a value trap, basically. And as you can see, technically, we've broken down. We're now approaching the 20,000 level. I would not be surprised if I think Steen will prove to be right on this, that they're seeking this confrontation, and that will cause investors to push the FTSE maybe even further down. And that was my case on Monday on Bloomberg. I don't really see any attractiveness of European equities because the financials are broken and we don't have any technology sector.
And so also the financial is quite a big share of the index.
Exactly, it's a big share, and we also have some utilities and telecommunications. So it's not really an interesting index. You're getting 4% dividend yield, but so what? You have zero growth.
Yeah. Well, we probably should have talked about the U.S. market because again the S&P has made some new highs this month. It seems like it's a safe haven right now. But I think we'll pick that up next week because we got more to come through. But it's been a good month for the U.S. stocks. It's probably one of the few markets around the world. Because I think if we move to China, we had quite a bit of a setback for Tencent overnight.
Exactly. It's the story of China right now that we're sort of bouncing back and forth right now. We're trying to find a floor. Have we done that yet? Well, I have argued several times on the morning call that we could take a further leg down, and it all comes down to the Trump administration's response, whether they will do the $200 billion tariffs. If that's the case, I think we'll make new lows in Chinese equities. And the story on Tencent, if we look at the chart here, is that we're down 5% today. The Chinese government is now pushing through the plans to make a big gaming reform, so they're going to curb the amount of new games that could be introduced into the market. They're also going to introduce new rule sets for how much airtime or kids can have on games. And I think from a scientific perspective, we know it's very easy to impact the brain in a negative way. It's addiction, right? So from a scientific perspective, I think probably it's a good move from the government. Obviously, for investors that are invested into Tencent, it's very negative.
But I also think we have to address the fact that the market in China today is not down actually, or it's small down only, despite Tencent's overlap. And you're absolutely right. I think when we come to the 6th of September, which is supposed to be the day where the U.S. announces that they're going to increase the tariffs, if we don't take out the low in the Shanghai Composite, if we don't take out the recent low in MSCI emerging market, then I think it's actually a huge buying signal that indicates what we've been talking about at length in this program and in terms of the research we do, that we are in a cyclical change where China is replacing U.S. growth as a bigger component of the total growth, which always means that we get a weaker dollar, but also that emerging market will start to perform. But it is, as you both said, it is with great uncertainty. But I think from a technical perspective, it's kind of neat that you can set up the trade here. If we fail to take out the new low, it's a definite buying signal, a confirmation of the rotation. If it's not a confirmation, then there's another 5 to 10% on the downside.
And I think on that note as well, we've seen the yuan has stabilized below 7 against the dollar. It seems like there's a line in the sand at that level. The question is obviously also how does the yuan react to an additional batch of tariffs if it manages to stay down here? Obviously there is some government intervention as well, but I suppose that could also help calm the market down.
Yeah, the counter-cyclical measure, which was announced last Friday, is of very, very high importance in the sense that it indicates that China, as in the past, is very willing to engage in the marketplace. So basically now you have a fixing of the dollar CNY, and then you have the basket CNY, and then you have a counter-cyclical measure, which really means the government decides where this rate is going to put. So I will expect despite the fact that we also expect the tariffs to go ahead, that they will control the currency. And 7 is a very, very hard line. As we've seen with the Hong Kong peg, I think it will have to be mirrored in the same way and interpreted the same way, that is a line that now will be violated unless we have another sort of new components to the whole equation coming up.
Well, that leads me into the commodity space, because the Chinese currency has had quite a significant impact on the market this month. But also, if you look at the table here, this is just to highlight some of the major commodities, the performance throughout August. It really has got, you can almost say Trump, because the energy market is higher because of sanctions, U.S. sanctions against Iran. The industrial metals are down because of worries about trade wars' impact on emerging market growth and global growth in general. And then the grain sector, you can see soybeans is the hardest hit because of the tariffs on U.S. soybeans into China. So it is really a big story right now, still what's coming out of the White House. Adding to this, we had a bit of weather, which is also providing another strong crop season in the U.S., which is also adding some pressure to the price. Let's just finish off with the calendar for today. We have a CPI from EU. We got the Michigan sentiment later today, and then we got some India the second quarter GDP. And Peter, you got a comment there?
Yeah, we might say already now that before we get the flash for the euro area, we already got the French CPI figures out this morning before this morning call, and it was a tad higher than expectation. So, and with the German CPI we got yesterday, it might suggest that we could get a slight positive upside surprise to the flash CPI for the euro area. But let's see. And
that's really what the ECB will be looking for as well, in order to normalize. Next week, I think we mentioned, talk about it several times, if we move back to the table, we got the tariffs to potentially be announced on China no later than Thursday, or after Thursday, basically. So that's a deadline after which he can announce them. And then we got the Swedish election coming up next Sunday. We're going to take a look at that next week. But I think that's it from us this week. Have a great weekend, and we'll be back again on Monday. This time at a slightly earlier date. We're going to aim for 8:45 CET instead of 9:15. Thank you very much.